Hello and welcome. You're with us here on Business Today TV, and we're continuing our series of market masters understanding best what to expect from the new Samvat as we count down to celebrating Diwali this year. Joining us on the show today, Devina Mehra and Nilesh Shah of Envision, both guests who I've been speaking to for many years and who we really look forward to speaking to at this time of year particularly. We assess all that's happened and try and figure out best how to maneuver the way forward as well. Welcome and thank you so much for joining us, both of you.
Thank you so much.
Thank you, Baba. Wish
Devina,
you a happy new Samvat in advance, and same to your viewers and your team.
thank you so much, Devina. Let me start off with you. It's been an interesting year, one where after some time we've seen flat returns coming in this time around, lots of global uncertainty, lots of structural shifts that have been ongoing as well. How have you assessed the year gone by?
So while at the end of it, we are more or less where we started from, but there were ups and downs in the middle, and I was just looking at some of my podcasts in February because that's when my book had just come out, and in all of them, I have said that if you were waiting for a correction to invest, have you invested? At that time, the Nifty was in the 22,000 range. So the point is that most of the time, number one, you should not have 100% in equity. But number two, whatever is your equity allocation, you should be invested most of the time, unless a crash appears imminent, which is not the case. And normally, sentiment is a contraindicator, and this is data research studies from across the world. It has been done in multiple countries, and it's the same result that when people are extremely bullish and euphoric, as was the case for the first 8-9 months of 2024, the next period returns are below normal. And when it is anxiety, fear, should I stop my SIPs? Should I get out of the market? The next period returns are above normal. So, that's the golden rule. So if at all you should look at lightening your equity, it should be in euphoric times, not when, you're already in the questioning mode. That's the thumb rule.
Understood. Nilesh, talking about questioning times, I'm not sure we're completely in the clear, far from it. We do keep seeing Trump, playing havoc with the markets. But on the domestic front, we've, of course, seen the beginning of reforms with what's happened on the GST. Do you anticipate further momentum picking up, at least on domestic shores?
No, absolutely. I think the domestic participation and domestic policies have honestly been very, very supportive. I think the fact that the foreigners have sold so much of stock this year, and that has all been lapped up essentially by domestic investors. I think that's at least been a great source of consolation, and that's been very heartening. Whatever has happened in terms of the global front, in terms of trade policies and some of the other things, have at least kind of brought in a sense of urgency to do more on the part of policymakers. And a lot has been done, whether it's essentially the RBI pretty much getting into a dovish kind of a mindset in terms of loosening liquidity or creating an environment of helping banks to essentially lend more, cut in interest rates. Similarly, the GST reforms or some of the stimulus that came out of the budget in terms of tax exemptions, I think are all very supportive of growth, very supportive in particularly of the consumption led economy. And I wouldn't be surprised if we actually get to hear a lot more from policymakers. I think there's already been a talk of at least that the whole committee is being set up to simplify, conducting businesses and helping businesses to grow. So I think that seems to essentially be the next big watch area. So on the whole, I continue to be quite relatively sanguine. And I believe that the year gone by has pretty much been like, I think markets also have their own bit of cyclicality. There's always a 3-4 year time frame in which 1 year is exceptionally good, 1 year not so good, and then a couple of years you keep meandering along the way. I probably think the year 25, calendar year 25, has been a bit like calendar year 22, where markets were flat to marginally negative, and then we saw essentially in 23 and 24 markets come back very strongly. I think 25 has been one such year where markets have consolidated. And I wouldn't be surprised that on the back of all these policy measures, you actually expect next 1 or 2 years to be a lot better than what the last 1 year has been.
Okay, always encouraging to know that.
Yeah, let me just add to
Of
that,
course,
which
please
is
do.
that it is not just the policy measures, the macros have improved. And one big change has been inflation, which is now at like a multi-year low. And in several categories like food, it is not just that the inflation has come down, actual prices have come down. So that creates room in the household budget, which, because food is crowding out even essentials. And that has a positive impact on the top line because there's more demand, and on the bottom line because crude and downstream petrochemical prices are down, which are inputs for a great many industries. So there's a good impact on margins. So this was there even before GST. GST, while overall positive, has it will cause a minor hiccup in Q2 earnings. I was expecting second quarter earnings to be substantially better than first quarter earnings. That's the July to September quarter. Now, because the GST came in the middle, some purchases got postponed, and even after the announcements, there was some confusion on what to do with pipeline inventory, with dealers, with distributors, retailers, etc. So some of those sales will get pushed to Q3, and so I think the earning uptake may get pushed to Q3, but that's a minor detail. But that's something the viewers should just keep in mind when watching the results.
Okay, what are you both making of? And I'll come to the sectors in a moment, but I've got to ask you about the IPO market. Do you feel that we are seeing some capital move in there substantially? We just had Tata Cap, look at LG, then we've got another, bunch of huge IPOs from Lenskart and possibly Grow coming up as well. What are you making of it, and whether the action is more in the primary markets right now? Nilesh?
Yeah, absolutely. I mean, obviously, a great environment where there's appetite, domestic investors willing to essentially um, put money to work in fresh IPOs and new listings. I think it's a great place to be. But Abha, I think broadly over a period of time, participating in IPOs not necessarily has been the best way. You've got to be very selective, maybe just probably 2% or 5% or maybe 10% of the IPOs actually make money for you on listing, or maybe within 1 month of listing. So I actually think that on the whole, it just makes sense investors to kind of wait for the IPO to be done with, the listing to be done with. Look at 2 to 4 quarters of performance from these freshly listed companies, and inevitably you'll come across an air pocket where these companies do have 1 or 2 bad quarters, where then stock prices become more realistic. So I'm in that camp that I'm not necessarily very enthusiastic about all these IPOs. What it does to me is it just creates a pipeline for me for future ideas and future investments. But directly participating in IPOs, I'm not sure if that on an aggregate basis is the best place. Yes, you will make money in a couple of IPOs out of 10 or 20 IPOs, but on the whole, I'm not too sure that's a very rewarding experience.
Okay, a whole spate of them coming out. Devina, would you like to add anything there, or should I move on to sectors?
No, I mean, actually, the IPO market, I would like to tell the viewers that most of the time, when there is frenzy in the IPO markets, when the IPO market is so-called hot, it almost never makes sense to try, because most IPOs are overvalued, and the occasional one that is good business, good valuation, you will not get allotment of any. So people say, okay, 50% pop at listing, but I said of the amount that you invested, you look at percentage, you got allotment. Have you made money on that? And people are playing it like a lottery, not like, you're not looking at the business or the valuation at all. And always remember that the frenzy or demand at IPO time is absolutely no indicator of how the stock does thereafter. The example I've given in the past also, of course, Reliance Power and the like, people remember that so much demand for the IPO and that the stock practically went to zero. But even a company that did reasonably okay all this while, which was DLF, it did not see its IPO price for decades. On the other hand, the Infosys IPO, the younger viewers won't know, was undersubscribed. So the biggest wealth creator probably in the Indian market, the IPO did not even get subscribed. It devolved on the underwriters, and the underwriters made pots of money. So the IPO demand is absolutely no indication of anything. So this is not a sensible valuation, or rather investment strategy to chase IPOs when there is a frenzy. When the markets are calm, then you can probably still look at IPOs.
I love it, Devina, and I think those historical references are really great to reinforce this point, and clearly both you and Nilesh in consensus there. Nilesh, you've also, when we look at earnings and the fact that they need to catch up and catch up with valuations, what sectors would you look at to drive earnings growth? We've seen a shift through this last year. Going forward, would you put your money on a particular sector?
So I still believe, Abha, that most of the technology-led businesses or the businesses which essentially are growing or creating categories or expanding markets based on adopting technology to kind of get to consumers, I still think that's a great place to be. The space has done relatively well, but just to kind of flashback when these companies IPO'd in 21 or in 22, obviously at that point of time most of the managements of these companies were riding high. I'm not entirely sure at that point of time whether the unit economics for some of these categories was well established, but I think to give credit to them, I think over the course of the years 23, 24, many of these companies and businesses have established their unit economics. And at this stage, I think a lot of the spending that they do is very discretionary in terms of trying to kind of acquire customers. And then I think once you get to critical mass, there's enough potential for cash flows to generate. So I think if investors do have at least a 3 to 5 year horizon, I wouldn't be surprised if sectors which basically are what we normally talk of as digital platforms, I think are a great place to be. Just that I think obviously the sector has done very well, say over a 1 year horizon. So you probably will need to keep some powder dry. There will be volatility, and you will need some money to essentially be able to add into these positions. But that should be a great place to be. I mean, I still think from a 3 to 5 year perspective, I think that would be my top pick.
Any particular stocks from within the basket, Nilesh, if I had to pin you down on it?
I think we have a portfolio approach, Abha. So we essentially own most of the names around there, be it Eternal, be it Paytm, be it Exigo. I think these are, be it Blackbug, these are the kind of names we already own in our PMS and for our clients. So yeah, we have a vested interest. These are not recommendations, but I think we like all of these people, these companies. They have been able to essentially establish market leadership, and they have created strong entry barriers for others. Some have been able to create entry barriers. Some obviously it's still there's enough competition out there, and they're doing relatively well even in a competitive environment. So I think we like this space.
All right, amazing. Devina, for you, which are the sectors that are looking attractive? IT, financials, defense, consumption. Where are you looking within the markets?
So we don't have very concentrated portfolio. So I mean, there will not be a time when in our PMS we have like 30% or 40% in a single sector. We have been overweight pharma, healthcare, and auto ancillaries from about the beginning of 2024. So that still continues. We've added a few auto names along the way. One sector which has been coming up on our systems and where we've been increasing has been FMCG this year. So we are overweight there as well. Some have been stock picks in chemicals and all that, but that you can't recommend as a sector. Banking, we are normally hugely underweight. We are less underweight now. So we've added to banking because banking, if you look at last 5 years, so 20, 21, 23, 24, all of them, Bank Nifty hugely underperformed the Nifty. The only year where it outperformed was 2022. So it's kind of like making a comeback. Though as I say, I'm always a very nervous investor in banks. And we are not overweight, but we have added there. So that would be broadly where we have weightage. I mean, the others would be either market weight kind of thing or lower.
Okay, all right. How interesting. Devina, on the FMCG front, what's making you bullish on FMCG?
So pretty much what I spoke about in consumption, that demand has been picking up. Actually, the story in consumption, strangely, is that the bottom in consumption was 23, 24. When I think other than me, nobody was talking about it because the market was still moving. It is only in September 24 when the market started to fall that suddenly people said, oh, consumption is slowing down. When consumption actually had started to accelerate by then. And as I said, now there are these positive impact of the inflation coming down, of general GDP growth being okay. I mean, of course, nominal terms not so great, but still. So overall, things are picking up on the consumption front, because when the food prices had become that high, it was actually crowding out FMCG purchases. And as I said, there will be positive impact on the margins also, because crude is the other area where prices have come down, and therefore downstream petrochemical prices have also come down, which is a significant input for a great many industries, including FMCG. So, I mean, basically the sector has started to look better and better on our systems.
Okay. All right. Great. So in terms of the overall index and the way the market's placed right now, Nilesh, would you say we're undervalued? We're looking expensive. There's so many factors at play that it's hard to assess really which lens to look at it from.
So probably, I think the frontline indices at least are trading in line with long-term averages. I think they're trading probably at around that band of 20-22 times trailing, or at least in the Nifty companies, there isn't any significant growth. So you wouldn't be too off the mark with a range of 20 to 22 times valuations, which I would probably say is we're not over expensive, we're not too cheap. We're probably where we have been in line with the last 5 or 10 years. So I think we're in line with that. Yes, the growth sectors, the growth stocks, obviously, yes, they look optically expensive. But that's really been a trend in the market. I mean, as long as businesses do display relatively higher growth, they tend to carry much higher valuations. So I probably think that the businesses which essentially are growing at north of 20-25%, yes, they look expensive. But I still think that's really the place to be. Whereas, of course, what is really cheap is not growing. And equity markets are about growth and the price you pay for that growth. So I think it's a function of these two dimensions. So I think on the whole, I would probably still say that markets are more or less fairly valued right now.
All right, that seems to be like a pretty fair assessment. Devina, do you still feel that, one has to watch out for any kind of global headwinds? Is that something that you feel, we should still keep in mind, or do you feel that the domestic momentum will now carry us forward?
Risk is always something that you haven't anticipated. So it is always difficult to say what would be the trigger. Just to give you an example, in January 2022, The Economist brought out the January issue where they said these are the 10 or 20 geopolitical hotspots. And they did not have Russia, Ukraine, where there was a war the very next month. So you can be that off. So I don't think you should try to anticipate what is going to happen globally in that kind of detail. But of course, I mean, when talking of indices, we must remember that this time the market up move has been very narrow. It has started to broaden now. But actually, the pain for the investors has not been captured by the indexes. So if you look at about middle of August, from the top, all the indices right up to the small cap index looked only down 7 to 10%. But 85% of the stocks were down more than 25%. So it was that kind of a disconnect. Less than 10% of the stocks were outperforming the index, which, I mean, to give you a benchmark, normally you have 40+%, 40 to 50% stocks outperforming. When it comes down to 25%, we say the market is narrow. Here it was not even 10. It has now widened to maybe 15-17% stocks, but still on the average, the median stock is down in a sense which is not captured by the index. So in any case, index aggregates are not very meaningful because for one thing, the index composition has changed so much over the years that you can't look at long-term Sensex or Nifty PE and say make any sense out of that. For example, 20 years ago, there were no banks or lenders in the index. Now that's the highest weight. So that gets skewed. But industry by industry, if you see, the PEs are not at extreme ranges for certain. That's like nothing which is out of line with what has happened. I mean, PE doesn't capture everything, but whatever it is worth, that's the position. And as I said, I expect some earnings uptake.
Okay, fair enough. Nilesh, I know it's not been so exciting recently, but given that the government seems to be on a reform bend, we've got some interest is brewing when it comes to the PSU banking sector. From a reform agenda standpoint, do you think perhaps that could be an area one should look at?
Surely. I mean, yes, I think for investors who are very kind of pretty much comfortable owning banks, PSU banks could be a relatively fine place to be. I think the last 2 or 3 credit policies have been very supportive of the growth for the banking sector in general. But I probably think the most important event lined up essentially is the divestment of IDBI. If that goes ahead, that could essentially again be a key development for the entire PSU banking space. So I think investors and there seems to be a good chance that this would probably happen over the next few months based on some of the interviews which have essentially come in. It looks like that it is likely to happen by March or around that time. So I think if someone is looking at maybe 5 to 6 months, it might be a good way to play where you're playing both the event and obviously there are some policy changes which are supportive of the banking sector. So on the whole, I think it probably is a good place to be in from that context. But otherwise, I think outside of banks, I think specialized credit plays, there are fintech platforms. That also I think is a great place, and we're probably more optimistic on that side of the market versus just the pure banks.
Okay, so another one to note there from Nilesh. Can't close this conversation today without asking you both on what's happening on the precious metals. There's so much competition for the equity markets this year, from these IPOs to gold, silver. What's going on?
Quick one, Abha. This is probably for the first time in the last 5 years, at least, banks are not blaming equity markets for their loss of deposits. Uh, because last money, somebody's put his money in a bank deposit has probably earned 5 to 7%, and equities, obviously, the markets are negative. So at least we guys are not being blamed for the loss of deposits by banks. It's over to all the precious metals. I mean, gold, silver, they seem to be on a tear. But it's very symptomatic. I mean, and the kind of stuff that now the headlines that are making is that people don't have enough silver to deliver, and all of that, which probably at this stage looks to be a bit of a FOMO effect. That if you've not been in gold, you've not been in silver, you've missed out some crazy returns, and therefore there seems to be a bit of a chase to basically buy into them. The other angle which is being made out to be is de-dollarization. But I have seen this over the past. I mean, when you have these kind of situations, it's probably the opposite of that which happens. I mean, I wouldn't be surprised if in a year from now, equity markets probably end up giving you better returns versus gold, silver. I know this is not a consensus view right now, but I don't mind kind of having this view right now.
Okay. Devina, any advice to our newer, younger investors this Samvat?
Okay, so first of all, gold and silver, since you had asked,
Yes.
they should be part of your asset allocation, but they should never be a big part of your asset allocation. On the other hand, as being Diwali, let me say that our grandmothers were not wrong in buying gold at that time because that was the only currency hedge you had in the world. You could not access overseas capital market. Now you can. So now please, as part of your asset allocation, look at global investing and not just US is not the globe. And in terms of what happens to gold, just one statistic, I had seen this headline that gold has not seen this kind of rally since 1979. So what happened after 1979? Gold made a high in 1980, and after that it fell. And when did that 1980 high get crossed? In 2007, 27 years later. Even 19 years later, it was down 60%. And this is data we've calculated it. Gold in dollar terms is more volatile than equity. It is no safe haven.
Oh, wow.
So it has
That's a new perspective.
So rupee chart looks good because it is essentially a rupee depreciation chart. But now you don't have to access the world only through gold. So you can access much other things. As far as your younger investors are concerned, I would say do the boring stuff, do the asset allocation. Don't be at extreme ends of the risk spectrum. Don't be at 100% fixed deposits, and don't think you will become a day trader on derivatives or crypto or something. And start saving today, even if it is only 5% of your salary. So those would be the key things to do.
Fantastic advice, and it was so much fun talking to both of you today. I can see you're both more relaxed as we just count down this festive season. And it's always wonderful to hear your views on the market and some very sensible views at that. So thank you both so much. Great speaking with you. Thank you.
Thanks, Abha. And again, Diwali wishes and festive greetings to you, the entire team, and all the viewers.